We have to act now.
How do you know the bonds are worthless?
I read them.
No one reads them. Only the lawyers who put them together read them.
I don't think that they even know what they've made. The housing market is propped up on these bad loans.
Welcome back to Investment Tribe, where you've subscribed because you want to learn all about cryptocurrencies, NFTs, and other digital assets. Don't forget to leave us a thumbs up and enable the notifications so you'll be alerted whenever we post a new video. Michael Burry of the Big Short fame is back once again, and this time, he's predicting that we might be facing the biggest one, the mother of all market crashes. And now he thinks that it will be on the stock market, much like what Robert Kiyosaki is saying too, as he sold all of his shares on it. So in this video, we will consider why he is so sure about it and what we can do as investors to maximize our profits whether or not his predictions is true. As most of you may know, Michael Burry is a genius when it comes to the financial world. He predicted several bubbles way before many of us could even see them. And Burry's not just talking the talk because he bet his own money against these markets once he's so confident of their collapse. That's why he's made so much money over the last few decades for himself and his investors. In 2008, when he bet against the real estate market, he made $100 million for himself and $700 million for his investors. And in 2019, he earned another $100 million for being an early investor in GameStop, although he may have earned as much as $500 million had he not exited early. So if the man makes a prediction, we should listen, right? His latest position is against many popular investments. He told on his Twitter account that the company Tesla is overvalued. He reportedly bet against the company by holding put options of 8,000, or the equivalent of 800,000 shares. He also went against Cathie Wood's ARK Innovations ETF and had some put options there. Simply put, Michael Burry doesn't back down. He even doubles down with his predictions. In June 2021, after resurfacing on Twitter, Burry let everyone know that he is betting against US Treasury bonds. He famously said that the markets right now are the greatest speculative bubbles of all time in all things, by 2 orders of magnitude. He's saying that everything from Bitcoin to Tesla to growth stocks to US Treasury bonds was all headed for a crash. His short position against US Treasury bonds is reportedly $280 million. But this isn't to say that his investors are earning money today. In fact, his fund Scion Asset Management was down 4.8% last year, or around $20.5 billion, while the S&P 500 has gone up 25%. He even ended up selling his put options against Tesla and ARK's ETF, ending his bet against them. So it seems that Burry is now focusing solely on betting against US Treasury bonds, one of the most stable investments. Well, this is his opinion. He thinks that as lockdowns end, people will be spending freely, and with a much pent-up supply from stimulus checks, we are going to see much greater inflation. In US Treasury bonds, its price is inversely proportional to its yield. So if inflation goes up, interest rates and bond yields are also up, making the bond price go down. And if the yield drops, Treasury price increases. Burry might be correct once again, because the data shows that the CPI, or the Consumer Price Index, which is used to track inflation in all sectors, has risen by 6.2% over the past year. That's why Burry is saying that we could be seeing a much greater inflation right now. However, Cathie Wood thinks the opposite, as she's more worried about deflation. Treasuries are not the only ones affected by inflation because all investments might be collapsing as well. If the US dollar devalues during inflation, the government will target its competition like Bitcoin and gold, making certain regulations that will drop their values. Growth stocks will be heavily affected because they rely on borrowing money to grow, and their interest rates get more expensive. Burry considers the assets he's tweeting about like Bitcoin, EV stocks, and meme stocks are driven by speculative fervor. These assets are being fueled by speculations alone, and the coming inflation is the needle that will pop this bubble. So why did Burry cancel his bet against Tesla and ARK? According to him, they were only short-term trade and he never intended to start a war against Tesla. But he still believes that the company is way too overvalued, calling its $800 million evaluation ridiculous. But Tesla's value has only gone up nowadays despite this. Inflation is one indicator to look at, but there are several ways. One of them is the price-to-earning ratio, or the PE ratio. We mentioned this in another video, but we never explained it. So here we go. It is the ratio of a company between its current value or its current stock price divided by how much it earns each year. For a company that's not growing or shrinking, the expected value revolves around 12 to 15. But if we look at the S&P 500 right now, or the 500 largest US companies, they're averaging about 30. That's a record-breaking value since we started tracking the markets in the late 19th century. Not to mention, many news outlets right now are telling us to sell our stocks already. So, should we? With all the data and warnings, should we just sell our stocks and wait for the impending doom? Well, here are some reasons why selling today would be a terrible move. Let's start with the PE ratio. You might believe that with the high average of the PE ratio today, it will revert to its mean or even go beyond lower in the near future when the value of these companies drops. Well, it can happen. But remember that the PE ratio has two factors: the company's value and the annual earnings. So another reason why the PE ratio might suddenly drop is the latter. It might be that these companies' earnings are getting higher. And the companies today are on that trend, especially with the tech ones like Facebook that grows its revenue by 35% each year. So you need to look at the two sides of the coin before panic selling your stocks. But what about all those articles warning us about the inevitable crash? Well, that's the thing about these predictions. They're just predictions. No one really knows 100% what will happen in the markets tomorrow, the next day, the next year, even the next decade. The thing is, if one article posted a warning, other news outlets will pick it up and report the same. It's sensational journalism, and that's what the audiences want. Case in point, in 2016, many articles came out telling us to sell our stocks because they were at an all-time high. Well, 6 years later, they were even higher. Experts say that if you invested all of your savings in 2007, possibly the worst time to invest in stocks, you would practically take back all of your losses in 2012. And you would even have tripled that money today. Warren Buffett famously made a bet against a hedge fund company to see which method of investing is more effective. Buffett chose the passive way. He just invested in an S&P 500 index fund and waited while his opponent actively played the market, buying and selling stocks strategically based on their trend. Guess who won that bet? Buffett did. The main takeaway is that markets fluctuate constantly, but they tend to gradually rise given enough time. But what about Michael Burry's predictions? Clearly, the man could never go wrong. He predicted all of the major market crashes in the past 2 decades. Survivorship bias comes to play here. We tend to only look at his hits and forget to consider his misses. Burry might be a genius. He sees something that we can't see, but he's still human. He makes mistakes. For instance, Tesla is still increasing its value with no signs of dropping, as well as GameStop. It rose even 5 times higher than when Burry sold his stocks. But then again, people did not believe him in 2007 also. The point is, we can never be sure. As John Maynard Keynes said, the stock market can remain irrational longer than you can remain solvent. In 2020, a study by Greenwald and Associates revealed that only 11% of people with an investment of $100,000 or higher thought of a market downturn that year. And you know how the financial advisors did at the same study? Only 6%. These people do this for a living, yet they did worse than simpletons like you and me. So looking at others for market analysis and just echoing what they're saying is never a good move. So is there hope in all of this? Is there a chart or data we can look at and correctly predict a market, or at least be half right so that we can prepare for it? Well, there is. Sort of. It's called the inflation-adjusted interest rate on US bonds. If a bond has a negative interest rate, it means that the stocks would be either flat or down over the next 5 years. It never missed for a very long time, but it suddenly stopped being correct. In June of 2020, the interest rates were in the negative, but the market exploded. So it's not a clear indicator anymore. It just proves my point earlier that no one can predict the trend 100% correctly. Correlation does not always equal causation. To give you a perspective, someone analyzed the Dow Jones versus Tiger Woods' performance in tournaments over a 15-year period, and they were in perfect sync with each other. It even guessed the 2008 market crash, believe it or not. So is Tiger Woods' golfing career a good indicator for the stock market movement? Of course not. But it just goes to show that with so much data available, you can always find two that have identical graphs. Numbers don't lie, people do. That's why the best strategy for me is to just hold, commit to my investments in the long term. If the market rises, I'll make money. But if it drops, I will look at it as an opportunity to invest more because I just know that it will recover given enough time. Many people sold all of their stocks when the 2008 crash happened and just never went back. Maybe because of trauma or some other reason. But one thing's for sure, they are having a hard time making money right now and being wealthy because they missed a lot of opportunities. So that's our video for today. What are your thoughts about Burry's predictions? Let me know in the comment section down below. Well, that's all for now. This is Investment Tribe. See you again tomorrow. Keep in mind to like, share, and subscribe.